So now this particular class, I've already talked about, introduced everything. Now, the difficulty that most people have is on where to place their take profits. You understand? And like I said, the way we determine our take profits is by targeting the nearest draw on liquidity in the markets. Now, that being said, this is actually when I will introduce the different types of liquidity that we have, because the only type of liquidity that I've introduced to you guys is the inducement liquidity, which we use for entry criteria. For picking our entries, inducement to be swept, the market will now what trigger your main point of interest. Now, aside that inducement liquidity, there are other type of liquidity that we have in the markets. It's actually those types of liquidity that we have in the market that can help you out with taking profits in the markets. Now, which are the types of liquidity that we have? Now, we have, first of all, we have trend line liquidity. So if markets, sorry, if price is on a particular trend, either it being an uptrend or a downtrend, for example, if price is making a series of higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, just know that there's liquidity being accumulated on the what? On the downside of this chart here. That's side of the trend. There's liquidity being accumulated there. Same thing as if price is making a series of what? Lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. There's liquidity being accumulated on where? The upside of this chart. Now, market moves from liquidity to liquidity. The first liquidity that market will take out if you want to trigger your entry is what? Inducement. After the inducement liquidity has been taken out and market triggers your point of interest for reversal, what's the next thing it does? It starts going to the other draw on liquidity where there is liquidity in the market. So having an idea of where the liquidity lays in the market will actually give you an insight on where you should expect market to take your profits. Now, let's assume, for example, now I have a sell point of interest somewhere around here. So the pattern that market makes in the market before approaching your point of interest is very crucial. Now, if before price approached my point of interest, the pattern that I used to approach my sell point of interest is what? A series of higher highs and higher lows. Me knowing that there's what? Liquidity being accumulated on the downside of the chart because it's an uptrend. I know that where liquidity lays in the market is what? This trend line liquidity. So if anything happens and I'm to take my sell from this sell point of interest, my take profits, sorry, if my sell point of interest triggers and I want to take myself from here, my take profits should what? My take profit should aim at clearing what? At clearing the trend line liquidity that market was forming, because that is the nearest draw on liquidity in the market. So the pattern that market uses to approach a particular POI is very crucial. That pattern that market uses to approach a POI will tell you where your draw on liquidity should be. Now, wherever there's liquidity in the market will eventually go out and take out that liquidity. And like I said, the one type of liquidity that we have is what? Trend line liquidity, uptrend line liquidity, and downtrend line liquidity. So in a scenario where market is on an uptrend, making a series of higher highs and higher lows, there's liquidity being accumulated where on the downside. That's eventually, if the market starts reversing, it will reverse and clear what? That uptrend line liquidity that market was making. So by clearing it, it will sell because it was on the previous uptrend. It will sell and sell until what this trend line liquidity has been what taken. Sell here before price approached this breaker around this zone for the sell. What was market doing? It was in a series of what? Higher highs and higher lows, which is what? An uptrend. Higher highs, higher lows, higher highs, higher lows. And it eventually what triggered our sell POI. When it triggered that sell POI, what did we observe? Where is nearest draw on liquidity? The pattern that markets use to approach our POI is what? Trend line liquidity. So because of that, the place that you're going to target as your take profit level is where to clear that trend line liquidity. Now, a lot of people will now start looking for buys from this other block here and another buy again from this other block here, which is very, very, very wrong. Don't look for reversals if market has not taken out liquidity yet. If market is selling now, don't start looking for buys until the liquidity has been taken out from the sell side before you can now start looking for buys. So people that are looking to take buys from here will be taken out. People that are looking to take buys from here also will also be taken out. Why? Because these buys, these other blocks are still inside the trend line liquidity and market has not swept it yet. So if you have to take a sell from here, you'll take profits you target what? To clear the trend line liquidity that market made before approaching your sell point of interest. Same thing as here, this sell POI here. Before price approached this sell POI, what was it doing? It was making a series of what? Higher highs and higher lows. Higher highs and higher lows. Higher highs. So this was what? An uptrend. And this uptrend is what? Uptrend line liquidity. So now the pattern that price used to approach the sell POI is what? An uptrend, meaning that there's what? Liquidity laying on the downside of this chart. So if you are to take your profit for this sell, you should ensure that your sell clears what? The trend line liquidity that it formed right before it approached our point of interest. So if I take my sell here, my take profit should what? Should target clearing what? This trend line liquidity. So the pattern actually that price uses to approach POI is majority of the time is trend line liquidity. I swear. Majority of the time, before price approaches any POI, the pattern that it uses to approach any point of interest is what? Trend line liquidity. Go back and observe it. If you want to take a buy, observe it. Even this sale that I took on a 3 hours time frame, then before price approached my breaker for this, my sale that I took, price was what? On an uptrend, making a series of what? Higher highs and higher lows. Higher highs and higher lows. Higher highs. Well, so what was this? This was what? An uptrend. Not just an uptrend, there's liquidity laying what on the downside of the chart. So before price approached my POI, it was on a trend. So if it's going to approach a sell POI, it will be on an uptrend to approach that sell point of interest. If it triggers that sell point of interest, my take profits should what? Will aim at clearing that trend line liquidity that price used to approach my point of interest. So price will use an entry liquidity to get you into the market. The entry liquidity is what? Inducement. You will see your inducement, price take out inducement, then trigger your POI. Then you use now the exit liquidity to get out of the market. So now exit liquidity, majority of the time, is now what? Trend line liquidity. Even here, before price started buying up here, what was it doing? It was on a downtrend, making a series of what? Lower highs and lower lows, lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. Before it triggered a POI here that started reversing this market. So what was this? This was what? Trend line liquidity. When it started buying, what did the market stop buying? It bought and bought and bought until what happened? Until it cleared this downtrend line liquidity before it eventually started selling. So you don't look for reversals in the market except liquidity has been completely cleared. Once liquidity is being cleared, that's where your target should be. You don't try to overlook you don't try to look for extend TPs when you already know where your nearest draw on liquidity is. So majority of the time that price approaches a POI, the pattern it uses to approach that POI is trend line like. Then because it's trend line, the liquidity that we'll be looking to take out is what? Trend line liquidity. If you observe, majority of the time, even when it approaches our buy here, before it approached our buy, it was on a what? On a downtrend. You can see lower highs and then lower lows. You can see lower. This downtrend consists of what? Trend line liquidity up here. So if I try to take my trade, market will what? Will buy until it what? It clears this downtrend line liquidity. So that is one type of liquidity. That this topic is actually complex type of liquidity we have. It will better tell you where you should take your profit. So if, for example, before price approached our buy point of interest, it was on a downtrend, making lower highs and lower lows, lower highs and lower lows, and this happens to be our buy point of interest. If I'm to take my profits, my take profit should aim at what? At clearing the trend line liquidity that market made before it approached our buy point of interest, which is here. That should be your TP1, like your main draw on liquidity that you look out for is there. That is the nearest draw on liquidity. You understand? So before market approaches a POI, there's a particular pattern it uses to approach that POI. If you can identify that pattern that market uses to approach a POI, it will tell you where your take profit should be. That is one type of liquidity that we have. Another type of liquidity that we have is what? Range liquidity. Now, what is range liquidity? The market is consolidating or ranging, basically traveling from what? Support to resistance, from resistance back to support, support to resistance, resistance back to support, support to resistance, resistance back to support, support to resistance, resistance back to support. While it's doing all this, it's basically accumulating liquidity on each side of the chart. You will see liquidity accumulated on where? On the support zone, and liquidity accumulated on where? The resistance zone. This is called what? Up here is called buy side liquidity, and down here is called sell side liquidity. So because liquidity has been accumulated on both sides of the chart, how do you now know where to take your profit? Now it now depends on which one gets swept first. So as the market is now going for a sell, and there's a sell POI up here. If price eventually comes here and sweeps this support and this resistance uh, a liquidity and triggers a POI here for a sell, the market should start selling from here. Your take profit should aim to clear the liquidity on what? The support side, which is to target the liquidity that is here on the support side and clear it. That is what we call range liquidity. So if the market is ranging support resistance, resistance support, support resistance, resistance support, there's liquidity being accumulated on both sides of the chart. Now, whichever one, now, if the direction of the market, now, for example, you're looking to buy, you understand? If you're looking to buy, a market happens to come out and take out the liquidity on what? On the support side and triggers a buy, then your take profit should aim at clearing the liquidity on what? On the resistance side. You're looking to sell and price comes and then triggers the and sweeps the liquidity on the resistance level and triggers what? A sell. Your take profit should now aim at what? Clearing the liquidity on what? On the support side. Now, example of that is what happened on DJ last week. This is actually an example of ranging liquidity. Price was basically ranging from here to support. It's not really that clear, but this support to this resistance. This is it. This is the ranging liquidity. This support to this resistance down to this support to resistance, resistance down to support. So that was what market was doing until eventually what? The support resistance got taken out first. So that was a liquidity sweep. After that, market triggered a buy. So now, if I'm to take my buy here, what will my take profit? My take profit will now aim to take out the liquidity on where? On the resistance level. That is the buy side liquidity. So this one is an example of ranging liquidity. The other ones I was giving before is an example of trendline liquidity. Now, I will tell you this, the pattern that market uses to approach a POI the most is usually what? Trendline liquidity. The pattern that price uses to approach a POI the most is usually trendline liquidity. If market wants to buy now and it's approaching a buy point of interest, trust me, 80% of the time, market will use trendline liquidity to approach that buy entry. If it approaches that buy entry with that trendline liquidity, if a liquidity being formed is giving an example that money is in the market. For example, now if you're looking to sell and before price approach to your sell POI is making a series of lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. This gives me enough conviction to actually go for a buy. More than market approaching this my POI and it approaches impulsively like this, like very fast and triggers it. I won't be convinced to take this entry, but I'll be convinced to take the one that used the downtrend line liquidity to approach my POI because this is showing me that there's money on the market laying up here. That market will eventually come out and sweep. Sorry. Can you guys hear me now? Can you guys hear me? Sorry, someone called and interrupted. Can you guys hear me? Okay. Okay, good. Sorry, someone interrupted. Mm. So where I stopped at, I said the pattern that market uses to approach a point of interest is very crucial to the reaction of that point of interest. So paying attention to how market approaches a point of interest will tell you where your target should be. Before market to approach your point of interest, it's going to approach your point of interest using a particular pattern. For example, down here is what? A buy point of interest. And if you pay attention, before price approaches our buy point of interest, what was it doing? It was actually in a trend-like manner. Lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, sorry, lower highs, lower lows. So it used a downtrend line liquidity to approach this buy POI. What does that signify? It tells me that there is money laying on the upside of this chart because there's liquidity there. So if I'm to take my buy should what? Should aim at what? Clearing the trend line liquidity that market was creating when it was coming down to my buy POI. That's why I can take a trade and literally target my take profit. You guys can be okay. Why is it take profit? So how do you know the market is going to get there? Because I know where liquidity lays in the market. So all these other blocks here, I'm not going to be taking sales here and here and here and here because I already know that the what all these other blocks are embedded inside this trend line liquidity. And me looking to take a trade for reversal when the liquidity has not been cleared is not valid to me. So understanding the pattern that market uses to approach any POI will give you a confluence on the direction that you're going to be trading the market in. Now, the sell POI that market sold from was around this breaker here. Now, before price approached that breaker, what was it also doing? It was what? On a trend line liquidity, making higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. Higher. So this was what? A trend line liquidity. This, in this time around is an uptrend line liquidity while approaching a sell point of interest. It means that this right here, literally everything here is what? Liquidity. And eventually, if markets should start selling, I expect market to sell until it clears that trend line liquidity that market was accumulating while it was approaching the POI. That means if I'm to take a sell, my sell should what? Target clearing what? The trend line liquidity that market made. That was why this sell happened to sell, sell, sell until it's cleared this entire liquidity here. So the pattern that market uses to approach a particular POI is very crucial to understanding the behavior of markets at that particular moment. The pattern that market uses to approach a POI is still very crucial to understanding where your take profit should be, because that your take profit is what should be where the nearest draw on liquidity is. Now, I've talked about trendline liquidity and I've talked about ranging liquidity. Another type of liquidity that we have is equal highs and equal lows liquidity, which is really not the most used type of liquidity, but it's still another type of liquidity. And it can also be used in the market. Is when market forms double bottoms or double top, like most people call it. So if market makes an equal high, which is a double top, just know that there's what liquidity laying on the upside of the chart there. And if market makes an what? An equal low. This one that's liquidity laying on the downside of that chart. It means that eventually, if for example, market is about to buy, and before market bought on the upside, they made a what? An equal high, which is a what? A double top. If it does something like that, it means that if price should start buying, your take profit should aim at what? Clearing the trend line liquidity on that upside. And if market is to sell, and before market started approaching your sell POI, it's made a what? An equal. Let's say, for example, this is your candle. Market is going down, going down, going down, then comes down here, goes up again, then comes down and makes a what? An equal low. And what you're expecting from this market is sell. If market should go and trigger a sell point of interest, it take profits to sell until what? That equal low in the market has been cleared. So that is another type of liquidity that we have, equal highs and equal lows liquidity. Now, another type of way you can take your profits in the market is by using recent highs and recent lows. What do I mean by that? If, for example, now you're looking for a buy and initially the market is on a downtrend, making what lower highs and lower lows, lower highs and lower lows. lower highs and lower lows, lower highs and lower lows. Then it does what? A market structure shift to the upside. After making a structure shift, you come back and what creates your liquidity, and then what continue buying. Here is your inducement, and then the POI that you use and take your buy is right here. If you're taking your buy, it is understandable that the nearest draw on liquidity that you should target is what? The recent high that market made before it came to trigger your POI. So you can as well keep your take profits here. And once price triggers your buy point of interest, you target here. This recent high is your nearest draw on liquidity, which is basically what market does here. You can see multiple times it has happened. Market is on a sell, goes down here. After going down, it came here, created your inducement, and still sold to that direction. Then came back up to now trigger your what? Sell point of interest. The recent low in the market is what? Down here. So you can keep your take profits here. Price will come and use that recent low as a nearest draw on liquidity in the market. So that is another way you can take your profit. And another way again that you can take your profit in the market. So I'm sorry, this is a whole topic. After this class, I will send the recording. Please go and backtest it. Watch the video, backtest it again before you come with questions. This is not like every other topic. Every time I've taught every single set this particular topic, I tell them to go and actually backtest it. It's a lengthy topic, but it's something that you have to backtest and backtest and backtest. Because taking profit can be very crucial and they can actually destroy a lot of people. You can take your profit too early, and some people will end up holding the market until they start reversing on them and they don't know. So after I'm done with the class, actually take your time to watch the video, backtest, and come and ask questions, because I know why I'm saying that for this particular class. It's not something that you can just come out willy-nilly and start understanding immediately. You have to actually take time and get a hold of these different types of liquidity patterns and then actually observe it in the market and notice how it plays out. So another type of way you can take your profit in the market is now by what? By using valid points of interest that can cause a reversal in the market. What did I say? Using valid points of interest that can cause a reversal in the market. What do I mean by that? So let's say for example now that you happen to be selling your market from here. And before that, you now pay attention and observe that, okay, you are selling your trade, but there happens to be what? Another block down here. You now observe this other block, does it really fit the criteria of taking a POI? You now check your criteria of taking your POI. It has to trigger a structure shift. You now pay attention and notice that there was actually a structure shift to the upside here. The second rule now says it needs to have liquidity protecting it. You notice what? That there's actually liquidity here. The third rule says what? It needs to be unmitigated. You notice that, okay, this other block is also unmitigated. So it's giving you an idea that this other block can actually be a possible reversal point. So if you're taking a sell here, it is actually advisable to do what? To keep your take profit before that other block that market can possibly cause a reversal from. Because if you take your profit and extend it down there, let's say for example, it's extended down here, market can actually probably sell, come to this other block, bounce here, and then take you out. So like I said, we have trend line liquidity. We have equal highs and equal lows liquidity. We have range liquidity. And then we have you taking your profit using the recent highs and recent lows in the market. And then we also have what? Taking profit at valid point of interest that can cause a reversal. That is it. If you can get your basic understanding of market structure, understand where your market shifted structure, understand where your inducement is, which pretty much almost everybody understands, because I see people sending me their setups, the playouts and everything, and I'm actually very proud of this session, this set, because they're actually doing well. But most problem that people have is now knowing where to take their profit. And most people also look for buys or sells too early in the market when liquidity have not been cleared. Now, for example, let's say, for example, the market is on a downtrend, making lower highs and lower lows, and then it triggers what? It triggers a buy order where market is supposed to start buying from. And then you now start selling too early, maybe from here, or selling from here, not knowing that this is actually trend line liquidity. And before market can actually look to sell, all this liquidity has to be what? Swept. Now, if you have an understanding of that liquidity concept, in general. Understand that the trend line liquidity, before you can start looking for reversals, you have to wait for your trend line to be what? To be swept. It's only after one liquidity has been taken out that you can now start looking to take a trade on the what? The opposite direction. That will tell you not to start taking a trade too early, not stop taking your buys too early or stop taking your sales too early. So it's also another concept of knowing that, okay, if market is on a range from support to resistance, resistance to support, ranging there, and then one side of liquidity gets taken out and market triggers, for example, a sell, that is not advisable for you to now start looking for buys at the support zone again. Why? Because one side of liquidity has been taken out and market will not possibly reverse until it takes out the other side of liquidity. So these are basic knowledge that you need to get acquainted with. Once you have gotten acquainted with this type of knowledge, it will actually tell you not to be taking buys too early in the market and not to be taking sales too early in the market once you understand the concept of what's liquidity. So that is basically it. Please, for this particular session, this session is not like every other session. Do you understand? Please take time to study this particular topic. I'm very serious about this one. Take time to study this. Like, once you are done, just go open your charts, write trend line liquidity, find 10 setups that you've taken in the market, observe how market made an exit from that trade, observe the type of liquidity that was formed before that exit, write it down. There was a book I used to learn this liquidity thing in 2023, December. That was when I learned about these types of liquidity. I've lost that book, but I think I posted something about it one time like that. This was in 20, I'll find something, I'll take a picture of when I was learning this, 2023, and it has helped me till now, knowing that I should not be taking my buys too early or my sales too early because I understand the liquidity concept. This is not a topic that you can approach willy-nilly. Take time and study it. I know why I'm talking about this for this particular topic, because take profits is one of the things that can actually destroy you in this market if you don't learn it. It can make you depressed and make you lose your entire setup. Like, I've been on a profit of, let's say, about 80 pips. You've seen profits, but you ended up losing your profit because you don't know where to take your profit. It happened to me last year. My own is I knew where to take my profit. I was just greedy. But imagine people that do not actually know. So the take profit thing is very crucial because you can have your perfect entry but not have a good exit. And that's very depressing. So please, this particular topic, take time to actually, I'm just giving you this as an assignment. Open up your chart, find entries that have happened, then get the type of liquidity that markets used to exit. You understand that the majority of the time, the exit is trendline liquidity or equal highs or recent highs and recent lows. But that I want you to actually backtest it. You understand? Get like 10 setups that are played out. Get the type of liquidity. The entry liquidity is always inducement, but the exit liquidity is now the crucial thing. So either is in a range or trendline liquidity. So that is basically it for this class. Please just do as I said now. Backtest. I will send once the recording is done, I'll send it. Backtest it. It's very crucial. Very, very, very important. Don't play with this particular topic. I know why this particular topic. It can destroy you. If you don't know where to take your profit, it can destroy you, I swear. Because there are setups that if you don't know how to take your profit, you would have lost big on. Like um, for example, now, let me see. For example, this buy here that market did before market. Let's say if you are taking a buy from this level here, most people now would not know what to take your profit. But me that understand liquidity concepts will see this trade and see immediately what downtrend line liquidity. If I'm taking my take profit, my take profit to what we aim at clearing that trend line liquidity. Now, if people that do not understand that liquidity concept happens to take this trade, what will happen? They will take their trade, they will have a buy here, buy will go, take out that recent trend line liquidity, trigger this reverse, and then what? Start selling. A trade that they were up about 140 something pips on, they will lose the trade. Why? Because they don't know where to take their profit. So that's why I'm being very, very concerned about this topic. Watch the video, go back to the chart first, get about 5 setups, the entry liquidity is always inducement, then figure out the exit liquidity from this type of liquidity that I gave, get them down. Range liquidity, equal highs and equal lows liquidity, trend line liquidity, then taking profits using recent highs and recent lows, and then taking profits using point of interest that can cause possible reversals in the market. Thank you, guys. Who is saying I should talk to them about stop loss? I know who is saying I should talk to them about stop loss. Eh, how? How? Like how? Talk to you about stop loss. How? Is that something I'm supposed to be in this market? And how do I know the current trend of the market? It's very simple. How do you know the current trend of the market? But you see the trend in the market now. The trend in the market, uptrend, downtrend, and range. If it's the uptrend, you will know by seeing a series of higher highs and higher lows. If it's a downtrend, you will know by seeing a series of lower highs and lower lows. Is that something that we have to be talking about here? That's market structure that we taught in the first class. Abi, if you've not read Candlestick Bible, how will I start talking about how to know the trend of the market? Um, please, that's it for this class, please. I'll still compile everything again in the next class, then talk about higher time frame directions, and knowing what market is reacting from on the higher time frame, and then knowing what market is going to. With that knowledge, knowing the trends you're going to be looking at on the lower time frames. So that will be on the next class. I'll teach about that one.